To help us take a look at what's been behind the recent sell-off in the gold, I want to welcome in David Fischer, the founder and CEO of Landmark Capital. David, great to have you back on Futures with Ben Lichtenstein. I want to dive right into it. We talked a lot with our guests recently about the impact of tariffs on the indices, but talk to us about how you see trade tariffs impacting commodities, specifically the price of gold.
Well, specifically, Ben, I think it's the number one drawing down the market. It has a lot of power. You know, there's tariffs going on right and left. Wall Street says we're on the verge of a tariff war, but Washington says we're just talking this thing through like a family would talk in an argument. Who knows what it's really going to be, but we're on the threshold of the actual tariff war. Canada, July 1st, put on 25% tariffs in retaliation against the steel and aluminum. We're talking China now putting a $300 billion that will be initiated, like a previous guest said, on Friday, July 6th. The EU is putting on tariffs. So, I mean, tariffs are all over the place, and it's dragging down the market. Even brought the Dow breaking through a 200-day moving average that lasted a 501-day streak here last week. So it's dragging down a lot of the markets. Gold is not recovering, obviously, at the 1240 level, 1242 level. I think we could even see gold go even lower from here. As we've been talking previously, I've been saying we're leaning more towards the downside rather than upside. But don't forget, it wasn't too long ago in September last year, I was saying on national radio, and before we became acquainted, I was saying with corporate earnings at 25% every quarter, it was phenomenal what the market was doing, and I was depicting a 10% correction in the Dow in the early of 2018, and completely it did happen. I was also saying in 1999, when gold had lost its luster, according to the Wall Street Journal, at 252, that was the very bottom of the market. So sentiment changes rapidly, and Alan Greenspan put it all together, that bubbles are formed, bubbles are created, and people forget about bubbles. But when the bubble bursts, emotion changes from exuberance to fear, a complete 180-degree turn. We will be in that environment. We're just not there yet.
Yeah, it's interesting to watch because we're testing right now. We're at those October, November 2017 lows, and down below that, as you mentioned, we've got like around 1,200 from July or August of last summer as well. But you know, you mentioned how investors, we often see them, investors seek refuge in safe haven assets during times of uncertainty or extreme volatility. And we know gold oftentimes is one of those products, but not so much so recently. Is there an event or a season you think that would cause, well, that type of flight to quality price activity in gold to come back, or has something changed?
Well, we're pretty surprised in my industry that there's not been this flight towards gold, but that doesn't mean that the red-headed stepchild is out of the family. So okay. I think there's going to be this flight, like I was mentioning, that we can't be surprised when this does happen. Right now, there's been a flight to the dollar. I mean, that's completely what's been taking place here. And you mentioned in the last segment that as the dollar rose in index almost to little mid-95s, not quite, the euro's actually not going down, and the euro represents 37% of the index of the dollar. So we're having a double whammy causing the dollar to go up, which is, you know, pushing down gold. So we have the perfect storm against gold. Be a contrarian in this environment. I think the number one influence, though, and the most powerful influencing is the Fed. You know, and if you look at the Fed, they had to create ZIRP, you know, zero interest rates policy, and they injected a lot of money in the system. In 2015, they started raising rates, retracting that through quantitative tightening. And while that was happening, the euro and the Bank of Japan was injecting money in the system. It wasn't too long ago where they were injecting $150 billion a month, and we were only retracting $10 billion. This month, Ben, is the first month where we see a negative money being drawn out of the system because the Fed now reaches $50 billion a month of retraction of money, and the foreigners, the euro and the Bank of Japan, are only injecting $30 billion. So this could be the catalyst, possibly, that might change the gold market. Merrill Lynch, Bank of America, said just Monday that gold is going to be at $1,400 by the end of the year, and they're assigning it to tariffs. I don't know. I'm scratching my head trying to figure out where they get that data. I'd like to talk to them. I don't quite see that. I'm more conservative than that. it's going to be a longer period of time before we reach 1400 than at the end of this year, unless something drastically happens.
Yeah, you know, David, I know that some investors feel that silver is actually undervalued. When you look at the gold to silver ratio, what are your thoughts on silver?
Well, silver is worse than gold. It's gotten hit severely. Ironically, the same people that said $1,400 gold are saving $1,750 silver by the beginning of the fourth quarter. So, and that's going to be the average through the remainder of the year. I don't see how they see those things. I think there's so much pull and drag going towards the dollar in the form of treasuries. And maybe that's because people are sidetracking their money and going into money markets and buying short-term treasuries, which is supporting the dollar. Maybe that's the reason why this is happening, and that's dragging down the markets. But silver is, I think gold has to move first to drag the money into the metal markets as the enticement to diversify into silver. So I don't see the technical trading of gold and silver being very fruitful right now in this environment, but don't count your chips out before you play your hand. This could turn around rapidly. We're only 1-2 headlines away from a big change. And if this goes into a full-blown trade war, that could be the catalyst that would cause silver to also make some move.
All right, David, last but not least, I want to talk a little bit about copper, because we've been recently getting some mixed housing data here in the U.S., and there's certainly concerns related to China. I'm wondering here, you know, we've recently tested the $3 level multiple times. We're just below that right now with all the uncertainty and the other metals selling off. Is copper, you know, pulling back and selling off just a matter of time? Is it inevitable at this point?
I think it's more inevitable. I think it's more downside to the copper rather than upside.
Okay.
When you look at the housing market, it is slowing down. New starts are not as big as we predicted it would be. As rates goes up, the cost of buying a house is going to be factored in. People are concerned about one thing, what their monthly payment is. And as that monthly payment goes up because of interest rates going up by the Fed raising rates, I think it's going to slow down housing, which is going to affect the copper market. China wants to rebuild their infrastructure and their whole electrical grid system. That's going to put some demand on copper, but that project has kind of been put on hold. I mean, look at what the Chinese market has dropped 20%, the Shanghai. And so they're not in the environment of the boom that they had a couple of years ago, which drove copper up quite high comparatively to where it's now. So I think we're leaning towards the downside in all metals: copper, platinum, palladium, gold, and unfortunately silver.